one thing that's been kind of interesting is there's so many people who yesterday, like, once again, it's not saying I'm not here to say the market's going to go up forever. That's not at all what I'm trying to say. I'm just trying to say too many people get too panicky when there's a one-day move. I think it's very important to look at things in a little bit longer term time frame, and that has to really depend on your kind of trading.
Yeah, no, that's really true. Everyone just gets moved by the daily news on what the Fed is going to do based on the comments made by one governor, and then now we have a steady stream of appearances. So it's just moving markets in a way that it has never before. And of course, part of this is also all the algorithms are primed to parse the news and they react faster than the humans, and then the humans follow, and then it sets off a cycle, and then you get a mean reversion, and then people are just scared because why is there so much volatility all of a sudden? We never used to have even 1%, 2% moves a day, and now all of a sudden we are seeing these big moves, and it's, I mean, I can understand why everyone is scared, but that's really all there is to it. And if you just focus, zoom out, and have a longer time frame, then I mean, so if we had seen 1%, 2% days anytime from 2016 to 2019, 20, no one would have cared. In 2020, you could have seen 4% moves in a day and no one would have cared. And now all of a sudden, it's the return of volatility is scaring people because they're just not used to it. And I don't think there's anything more to it than that. It's just regular volatility that people are not used to. Even in crypto markets, people are not used to 10% moves in a day, whereas I remember the times when Bitcoin would sink 25% in a day, and that used to be considered normal. And now we just don't see that kind of volatility anymore, so it's scaring people.
Yeah, is that dinging in your background, Kashop, or is that me?
No, it's in my background. There's something wrong with the smart home setup, so
Oh,
someone keeps trying to call us, and we
oh,
just get those pings.
okay.
Yeah.
Yeah, okay, good. I was trying to figure out which one it is. But yeah, no, I'm just looking at the markets, trying to think of all these people, you have to understand the volatility. Like you said, that's the first thing that I think is very important in the markets. If you don't understand the volatility, you're going to get in a lot of trouble as a trader. And understand the volatility means like what's the normal move? Like what type of regime are we in? Understanding that when the VIX is very low, these pops are going to be big. They're going to be massive. We're going to like hate them at times. They're going to be rough to deal with. That's normal. That's a very normal piece of this market, So when we're looking at these things, we have to kind of understand that first off. And so you can do this in a lot of different ways. If you have an ATR set up on your portfolio, just understand that you're basically able to look at the volatility day after day after day. And when volatility is, think of Bollinger Bands. When they get really wide, that's major volatility. When they're really tight, that's low volatility. And so, we're talking about right now is that we have these very tight bands in volatility, and when they hit the top and they break out, they're going to be big moves. And that's kind of the thing you have to really look for in this type of environment. Those shocks are going to be big, and this also leads to like things like Volmageddon and so on. This is the thing that a lot of people like. Now it's funny because we've been trading for so long, like we can talk about these things that have happened and that people just haven't lived through. Volmageddon was a situation that happened in 2018. Basically, you had the bull market of 2017, which the market, it didn't even pull back 5%, I think. It just continued up all year long, and everybody was like, "Wow, volatility's." I mean, and it did. It got lower than it ever has. I think volatility even got to a 10 handle at that point, which is absolutely insane. And then we had January happened, and I think it was February 1st. Can't remember the exact date, but one day happened and boom, volatility spiked. Basically went from, I think it was like a 12 or a 13 all the way to what, 40 or something crazy, like over in just a day. And that's very normal. Like that's not the most insane thing ever to me. I think most of the time when you see a very low VIX, the biggest thing you have to look out for is these huge correction days. And also, it usually ends up when it is a huge correction like that and the market just crashes out of nowhere. That usually ends up in a very quick move higher. Most of the time, it's just panicky people. Everybody's panicking. Not to mention, you've made money. When people have profits sitting all the time, they're going to make bad decisions. You're sitting there looking at the market. You've been up all year long. You're making all this money. Q1 is better than ever. Like you're basically sitting there just raking in dough day after day, and then next thing you know, you have this crash that happens. That crash, how little it is, like I mean, really, it was only a couple percent, but it's really in people's minds. It's like, okay, my money went away. So then they're going to make a bad decision, meaning, hey, I'm going to sell all this right now. Obviously, the bull market is over. I mean, people were talking yesterday and they were like, yes, this is it. This is the end. And it's like, once again, like I will happily admit those things when the trend really changes. Is the trend changing? That's a question you have to always ask in these situations. Did the trend change? Did something fundamentally change? We're way out of, we're moving up in such a way, we're way out of the realities of the market at the moment. However, the market doesn't just go up and all of a sudden crash back down to zero and go, okay, this is reality, so we're all going to go back down to zero. The market, it's in an uptrend. It usually doesn't have these crazy corrections, crazy crashes. They usually don't happen until you see a real breakdown. We haven't seen a change in trend. So as long as we haven't seen a change in trend, I'm not too worried here. And not to mention people like us, like I think our portfolios and what we talked about yesterday are set up to actually handle the next market environment. Like I think if it really did turn to something nasty and like money starts flowing out of tech and starts flowing into these other areas, like we're positioned completely right to handle that.
So I think that's the reason everyone got nervous, right? So there's this Chuck Prince quote from 2007 where he was a CEO of Citigroup, and he says, "When the music stops in terms of liquidity, things will get complicated. But as long as the music is playing, we are going to keep dancing, and we are still dancing." And that quote has been quoted so often, and everyone makes fun of him. But I think that's pretty much where we are today. Like everyone who's invested in tech knows that valuations are stretched. I mean, every single bull knows that. They don't argue with that. They just try to come up with other justifications as to why the market can keep going up, whether it's rate cuts, whether it's new environment, or whether software continues to keep eating the world, or whether the AI revolution is going to change everything. Like you have all these arguments, but when you tell a semiconductor bull that AMD has a 300 PE, that's not a disputable fact. That is just what it is. Whether you buy because of you're not scared away by the PE, or whether you sell because the PE is too high, that's up to you. That's a discretionary decision. But no one disputes the facts. Everyone is just nervous when there is a correction because they are eyeing the exit door and they see they are quite far from it, or they have to make major changes if this is it. And the more the market goes up, like you said, when you have a lot of profits, what do? You tend to get nervous because you want to protect your profits. But then on the other side of this, you have all these retail traders who have never seen a bear market, never seen a Fed rate hike cycle, never seen a really scary recession. And for them, it's like buy every dip. Why? Because they did that in 2020 and it worked. So let's do that again. And those people, whenever they see a dip, they come in and then they are emboldened to take bigger and bigger risks because, well, it works. And I think somewhere down the line, we are going to have an actual trend change. And the people who are buying the dip are not going to be making it out that narrow exit. Whereas the ones who are actually nervous about valuation but still holding strong, like I know you've been in the semiconductor trade and you're up over 100% on the SMH ETF, which is something that's pretty incredible. Like I would never have thought an ETF would give that kind of return, except for those leverage 3x, 4x ones. But you manage to hold the entire move. And I know for a fact that once it turns, you're just going to be out and you don't care what happens next. But There are all these people who have made money on the individual stocks who think AI is the next big thing. I'm pretty sure they're going to keep buying on the dip all the way down. It's something similar to what I saw in the 2021 bear market in Bitcoin. Like you had this move from 64K to 28K. People bought that dip. Then it went to 69K and they're like, hey, look at me, I'm so smart. The next dip, which went all the way to 31K in Jan 2022, they bought it. It peaked at 48K and they thought it's going to recover, it's going to go back to 69. And then it didn't and it went to 15K and they just got wiped out. And the ones who were in the altcoins got completely destroyed 95%. Sorry, not even 95%, 95, 99% down. And if they had their coins on an exchange, they panicked even harder. And you see, this is what happens. This is exactly how people turn life changing profits into life changing losses. And that's just not respecting the market action. And I think you're going to see when you have these volatile moves, I think you're going to see both kinds of behavior getting exacerbated. You'll have the nervous bulls cashing out because they don't want to miss their profits. They had a good run, they'll just lock it in. And you have all these people who are new to the market who will just buy every dip and then they'll blow up. And I think it's 2024 is going to be the year of extremes where we see both camps come out fully on Twitter, their differing philosophies. It's definitely going to get interesting.
No, I completely agree, and you know, I think it's important to also say the distinction between a trader and however, you know, I think people would call themselves traders and they turn into investors. You know, if for example, if and like you said, we caught the move in semiconductors and technology all the way back in 23. We've been long it the whole time. It's been a great trade. However, if it turns, I will be out of the trade and I won't even think twice about it. You know, whereas most of these people, and if they did buy back then, they've been in the trade, and then if it turns, they're gonna probably just buy more. You know, they're just gonna be like, it's gonna continue. I mean, there was somebody that was talking yesterday that was talking about like the pullback yesterday and how he's like, oh, it was a great buying opportunity. I loaded up on XLK, and I was like, what in the world would make you think that's like a buying opportunity? Like whether you're, you know, a breakout trader or whatever, there's no trader that would say, hey, this was a buying opportunity. We had a 1% pullback in a move that's gone up, you know, 100% or so, you know, like it doesn't make any sense. But I just see this kind of trading over and over again where it's, hey, yeah, I really like this trade, and then they start to fall in love with it, and they're like, Nvidia is really cool, it's going to take over the world, you know, EVs, blah blah blah, and they'll go down a list of things that are like, I don't even know how some of these things are even connected, but whatever. And then when your position goes against you, and then the trend changes, and then you're losing money in it, you start to come up with more reasons why you should just buy more, because you feel like everybody's always looking for that last trade. They continue to go for that last trade. The last trade that made money was Nvidia, for example. And so therefore, when Nvidia comes down, I'm going to look for like this is what I'm not saying I am, I'm saying what other traders do. They think I'm going to look for that next trade. Okay, well, there's going to be another trade in Nvidia, and it's like, well, why don't you look to all these other sectors out there? Why don't you go, hey, there's energy here. Energy looks like it's just starting to move. It's showing relative strength. It has all of the ingredients that technology had all the way back in the beginning of 23. So why wouldn't you want to take that trade? You know, you could look at it from a fundamental perspective. You could look at it from a technical perspective or a quantitative perspective. However you want to do it, that's the way you make money. You don't make money by continuing to look for the same exact sector and the same exact market over and over again. You know, I used to have like biases when I first started trade. I didn't want to trade things like technology. I didn't want to trade certain sectors. And then over the years, I kind of realized like, hey, this is how markets work. They just go through phases. Outperformance at certain points, they have underperformance at certain points. How do I find those things? And that's kind of the biggest thing I had to learn as a trader, which is how do I just figure out where I want to be positioned all the time? And so that kind of created my strategy and my system that I use to today. And now it's like all of these are the same thing. I don't think of any names in it. I don't think of any feelings about it. I just put on the trade. And it could be in energy just as well as technology. And then that also keeps my biases awake. So when technology has a crash or technology turns and energy is the outperformer, I'm just riding the energy bull then. So I think it's important as a trader, one is to not have too many emotions in your trading. If you have too many emotions as a trader, you will make big mistakes all the time. And then two is your biases. Understand what they are. Maybe you don't like technology stocks. Maybe you hate energy stocks. I don't know, but most of the people, however they have first made money, they continue to like those things more than everything else. If you first made money in something like Bitcoin, you're going to say Bitcoin's the best thing ever. You're going to only want to buy Bitcoin. You think it's the greatest thing in the world. If you did it in gold miners, same thing. So understand where your biases are. And that way you're not just continuing to buy every dip in whatever you like the most.
It's really hard to sell your winners. That's, I think, and the bigger the winner, the harder it is to sell. But to your point, I think one reason this market has been so different is so 2021, you had a big bull market in tech. And then in 2022, you had a big bull market in energy. 2023, it's tech again. 2024, it's energy again. Now, usually when you see a sector rotation, the same sector isn't going to come right back, and you're not going to have this rotation between just a couple of sectors going back and forth. It's going to be, let's say, in the previous decade, just off the top of my head. So the start was the commodity bull market. Then in 2012, you had the biotechs. Then you had oil all the way to the first half of 2014, and then fill in the blanks. I don't really know what worked for the in between period. And then 2016, you had the gold miners. 2017, you had this big move in crypto. And so you had a lot of rotation going on between the sectors. And right now, we are not really seeing that. It's tech energy with some other sectors like industrials make a cameo appearance, make a new high, and then they just fade away. Steel is all the rage for 3 months, and then no one cares about steel. And you just have this rotating dominance between just two big sectors, and the rest don't really participate for too long. So people who are on both the camps, so the energy bulls never want to give up on energy, even when tech is outperforming. The tech bulls will never touch energy because they think tech will always come back. And I think it's just a characteristic of this particular market that we are seeing this, because any other time, if you're bullish tech and it doesn't work for 2 years, you're going to look at other opportunities. Now it's like, it's temporary. I'm just going to wait for it to come back. Or with energy, it's the same thing. You have a bear market for, let's say, 6 months, it's temporary, it's going to come back. And then it does. And because the market is doing this, investors are behaving in a particular way. And whether this kind of approach would work in a different market environment, I don't know, but somehow it seems to be working today.
So I wanted to answer this question, which is it's perfect for you and me to talk about. Other sectors that do not have the same momentum characteristics like tech by PK. Great comment. Interesting question. Once again, so if we're looking at something like technology and going, okay, well, I want to always be invested in technology. You could say that if you're going to just hold the position for the next 30 years. But once again, like I don't believe I have an idea of how the world will look in 30 more years and how technology and how the sector will look. It's kind of like saying like energy, which this is a thing that you have to learn about cycles. I'm not saying you do per se, PK, just people in general, is that cycles are always shifting and changing. So if we go back to the 70s, for example, ExxonMobil is the biggest company in the world. Energy is the biggest sector at certain points. Industrials are the biggest sector at certain points. All these things change over time. That's not saying, technology in the next 20 years is going to be the worst sector. I'm just saying these things change over time. When energy was the best buy and the outperformer and did much better than technology for about a year and a half, actually 2 straight years. Basically, that was when energy was the smallest sector in the S&P 500. Now, technology is the biggest sector in the S&P 500 today. So what I'm saying is back then, energy was the biggest sector. Technology was one of the small subsectors at that point. So we have to kind of understand that first off. Saying that, okay, well, if you look at the last 20 years and you'd say technology since basically the bottom in 2009 has been the winner, therefore I always want to own technology stocks. That's not for what we do as traders. That's not exactly right either, because there's been plenty of times like 2021, energy was the major outperformer. Now you have to also figure out what type of investor are you. I'm a trader, so I'm looking, especially in those 1-year trends. That's where I really make my bread and butter. Those 1-year trends that are energy based, that energy and the reflation trade, for example, financials and industrials are outperforming, then I can be in those sectors. I'm outperforming. I'm able to be in energy and commodity producing countries. And all of these things basically boost my portfolio. And this way I outperformed the S&P 500. If I look at it another way and going, okay, well, I'm a very long-term investor. I'm actually an investor, not a trader who's telling myself I'm an investor. So I'm just buying something in my retirement portfolio, for example, and I'm buying Microsoft for the next 20 years or something. That's a different thing, completely different thing than what I'm talking about. I'm more talking about the fact that if you're a trader, you will notice that things go through cycles. And actually, I did have a overlay of this. I think it takes us completely out of the picture, but you guys will be able to see it. So this overlay, let me get that comment off. So this overlay basically shows how the cycle usually works. Now, once again, there's no map for trading that can tell you everything in the markets. But this kind of shows you that, okay, like at the beginning, think of 2020. You have 2020 happen. You have the crash happen. Out of the bottom in 2020, you had technology really leading the way. Then you had the other things starting to catch up. Basically, energy is hidden on this chart at the moment, so sorry about that. But cyclicals, and so on, you could say. But you look at the overheating period here. The overheating period is usually when you see energy kind of being the major outperformer. This puts a lot of inflationary pressure on the market. And when it puts all this inflationary pressure on the market, we're kind of going, okay, well, that's that melt up period that usually ends up back in the market starting to move down all over again. So back into that's a market top point where you see industrials, energy, and so on, inflationary assets, commodities, and so on moving up, putting a lot of pressure on the market, makes the market then come back down. So basically all I'm saying is, as a trader, I'm happy, like we've been long technology for a year. We're still long technology. It's still in an uptrend. If that trend changes, I would think of it differently. But once again, if I'm a very long-term investor and you say, hey, I want to own technology for a very long-term time, that's okay as well. And then he said, another question. Oh, I'll get to that too. That's a good one. I like this conversation.
So
if you guys have any, go ahead, Kushal.
Yeah, so let me chip in on the the momentum part. So Schlumberger used to be an oil field services company. And because oil stocks got no love, they just decided they are now SLB Tech. So they have become a technology company that's serving the energy industry. And this is kind of the reason why I think we consider tech stocks as outperformers. Because let's say you take something like Plug Power or any electric vehicle company, what do? Or Rivian or Carvana, they just take old business models, which in the olden days they would have been classified as industrials, transportation, something or the other, and now they are technology companies. Tesla is a classic example. So you have Earlier, you had a solar industry, and the companies that were installing solar panels on rooftops, they were considered solar companies. Then Tesla acquired SolarCity, and all of a sudden, solar is part of the tech industry. And you have all these different business models, different companies, and they're all classified as technology. So, I mean, technically, if you look at the ETFs, Amazon is consumer discretionary, Meta is communications, but we all just tend to lump them into the technology category. We don't really differentiate between one form of technology and the other. So when
Mhm.
you say that technology has momentum, it's because you take the best stocks from all the different sectors and you lump them together as technology. Then of course it's going to have momentum because these are the best companies in the world. Doesn't matter what industry they serve, as long as it's the so you can take a logistics company and call it technology if they don't operate any warehouses or trucks. So you have this is also one reason I think everyone gets confused with the term technology. And I'm pretty sure I can put together momentum stocks which you might classify as technology, but I might classify in some other subsector. And those momentum stocks exist. So whether it's in shipping, whether it's in energy, I can show you momentum stocks in Copper Explorers if you want. So there's Philo Mining, which has just gone straight up almost every single day like a tech stock. And it's there. You just need to know where to look. And the reason we don't look is because technology has all the attention, it has all the ad stream, and no one really cares about the other sectors, or no one, first of all, no one looks deep into individual stocks. It's all in the ETFs. And with tech, you have 10 different ETFs. So you have a cloud ETF, you have a cybersecurity ETF, you have a consumer
Software.
discretionary, you have software. Yeah, you have, I'm sure there's a hardware ETF somewhere, you have a Chinese tech
Communications.
ETF.
Mm.
Yeah. So it's, but you don't classify. So oil has oil producers, oil field services, and the XLE, and that's it. And now uranium, URNM. But you don't really have too many different subsectors or subclassifications. And that's part of the reason I think the momentum part gets confused.
Mm. No, that's great, and I'm glad PK brought that up because it's super interesting to kind of talk about that stuff because I think it's and he's also brought up, he's talking about more money to be made shorting tech than longing energy. And once again, it's a preference, like sure, like there could be, and especially a lot of people right now, technologies went up so much, people think it has to come down so much. It's just not how the markets work usually. But also, yes, markets always will crash harder than they move up and quicker. That's for sure. So you can make a lot of money shorting, but you can also lose a lot of money shorting. So it's a double-edged sword. Now, once again, I think the cool thing, and you might like this, PK, which is if you're trading futures, you can add an amount of leverage to trades. So if you're looking at something like energy, for example, and you're like looking, and same as with options, you're looking for a 1% move in energy. And let's say energy has lower volatility than technology, which isn't exactly true, but let's say it does. So if energy has lower volatility than technology, then I can raise my position. I can have a bigger position, use more leverage, and then I'm actually making the same money or more money trading something that I know is in a stable uptrend rather than something that I'm trying to short on the way up. But there's a bunch of different ways to skin the cat. Trading isn't something that I can tell you, hey, you got to trade this way. It's a hey, maybe, short-term trading, the way you're doing it, your style works perfectly to short things like tech, and just trade the indexes. And maybe my style is different. So, I can't exactly say, but I just want to thank you for the question. That was a fun conversation. And,
So
Dave talking about all the different sectors here and talking about he's been trading for a long time and I'll just bring it up here. So 30 years in the market, sectors old and new have been through many cycles. I try my best and don't overstay my stay in any sector. I may miss certain sectors and names, but try my best to risk manage my way through all the cycles. And I really like that because I think that's the real goal that we do here as traders. Like, it's not exactly saying, like, hey, I understand that technology has run its course and now it's going to come down and therefore energy is the way to go. It's that I'm still long technology. I'm starting my positions. Well, they've already started at the beginning of this year in things like energy and oil and so on. So therefore, if we started to come back in the energy space, these gains would absolutely take that over, and we'd have a great move to the upside still without being completely dependent on one sector. I think that's more important. The most important part of this conversation is just the fact that you can't um, really put a price on the importance of understanding the cycles and being able to move in and out of things and not be too emotionally invested in it. That's incredibly important.
So I have a comment on the what PK was talking about on shorting tech, and so I'm reading this book called The New Merchants of Grain. It's about the agri traders, and there's a section in it where they interview the son of a smallholder, a small farmer in UK, and the interviewer is asking him questions, and he's just saying that there was a question about how farming as a business works, and he answers saying farming isn't a business, it's a lifestyle. Because when you're a farmer, it's a lifestyle choice that you make to live away from the city in a rural area, do all the hard work, the physical hard work, and one cycle after the other is completely different, and you really don't know how it's going to play out. And I think the same thing applies to shorting. If you are shorting, that's pretty much a lifestyle choice, because it's not just numbers on a screen anymore. When you're shorting, you actually are betting against the companies and the investors, and people are going to hate you for it. And if you're a professional money manager, I mean, sure, you can have technical shorts, but I'm talking about the activist shorts, the dedicated short funds. You have a whole section of Wall Street who's going to hate you for it. You have a whole section of media who's going to hate you for it. Anytime there is a crash, they are going to pillory you and parade you out in public and say he caused the crash, he is the problem. And you kind of have to be mentally strong enough to deal with all this. Just like if you are a grain trader, you have to know that in times of shortages, the politicians and the media are going to come after you. So it's more of you need to have the mindset to take that. Whereas just being long energy, it's pretty simple. It's not a lifestyle choice. It's just you're rotating from one market sector to the other. Whereas if you want to be dedicatedly short tech, it is definitely a lifestyle choice. And I say this because I put out an article, a negative Twitter thread on NVIDIA sometime in last August, and I have got so much attention for it, like both good and bad. And then when I say something negative about some other company, especially the Bitcoin companies like MicroStrategy or the miners, I get so many messages like my comments are full, people hate me, and I'm in all these groups where people are like, what is wrong with you? How can you say that this company is overvalued, or how can you bet against the stock? This guy is a savior, or Jensen Huang is going to save humanity, or you get people on the extremely crazy spectrum just coming after you. And unless you can mentally take it, I mean, sure, you can just short and not talk about it. So if you're fine with not talking about your trades, that works. But if you want to short and have these conversations, and it helps to have these conversations, right? Sometimes you're short and you're just wrong. Like if you're shorting Netflix in 2006, you're just wrong. Or if you're shorting Amazon in 2018, which I did, you're just wrong, because I remember seeing someone's model on AWS being worth $1 trillion. And I thought, no way is it possible. And then it came true. And sometimes when you short these tech companies, the outlier event happens and you're just wrong. But so it helps to have those conversations, helps to go out in public and talk about it. But broadly, it's a lifestyle choice. It's not just a choice as to what investment you make. And it's also about controlling your risk, controlling your margin. And you don't really have that on the long side. If you're buying something and holding it for a long time, you take a nasty drawdown, you're still fine. If you're shorting and you take a nasty drawdown, you get margin called and it's over. And I think that's a big difference, and why it's easier to just right now it's easier to just go long energy than to be short tech. But I personally have combined both at this point, and I see the way to manage that risk, but just dedicated one or the other, I think it's easier to go with the long energy part than to go with just the short tech part.
No, I like that comment because it's interesting, right? Because you have so many things when you're looking at these markets. There's so many aspects to trading. Um, Once again, I think it's all of us who are good traders have it in us to easily tell people to go fuck themselves and just be okay with however we trade. Like, hey, it's yeah, like that's cool. I'm glad you have that opinion, but once again, that's not what I do, and so I will continue to do it this way. That's incredibly important. But once again, when you're attacked to that degree and you're getting yelled at and you're getting people talking to you and you have no idea, you don't even know these people, and they're made it their life's goal to mess with you and screw with you and yell at you about things that you're just like, well, I'm just putting together a thesis the best I can. Like, once again, that's what I do as a trader. Now, once again, it's another thing too to talk about as an analyst. It's also important to stoke that type of argument and that type of fire, because once again, you'll get into a situation where you can basically, a bunch of people will see your work. You're either right or you're wrong. And once again, it's very simple to, as a trader, we understand like, hey, the trends are very strong. I can't really bet against it. But if you look at it fundamentally, like there's no argument to say Nvidia isn't undervalued. Like there's no argument against what you said in that article. So that's the kind of thing that's always important to realize, is like there's no argument against what you said. The price action is the argument, because that's how we get paid. So we have to also understanding that price action is how we get paid, but also we have to understand there is risk out there, whatever it is. If you're a fundamental investor and you're long Nvidia, you have to read the bearish stuff and understand that, hey, this can actually turn on its head pretty quickly because of these reasons. It doesn't mean that I'm going to short it, for example. That just means that I might be long and I want to know the risks out there. And I think that's what we do. Like our job, I would be told to me over and over again when I first got in this business, talk about, people would be like, oh, what do you do? What do you do? And you'd say things like, I'm a trader. And really the truth is like, and what any boss or any colleague would tell me is like, no, you're a risk manager. You are a risk manager. So I think that's like, got to always be number one. And you can tell the people who professionally do this compared to people who are not. The people that constantly fight about the risk and are like, oh my God, there is no risk. Nvidia is going to go up forever. This tech trade, I'm long tech, I'm long semiconductors. I'm still not going to sit there and say, hey, this is going to just go up forever and I'm happy. And you know what? I'm going to take my stops off, like just run it forever because it's never going to go down. Like that's ridiculous. That's not trading. That's hoping. And like the biggest thing that they always tell people as traders is like, hope is the worst thing you can do as a trader, because then you're just holding on to a trade. And then you do the crazy, you always hear the traders and new traders do this too, I'm sure, which is, and these are the old stories that would happen like from floor traders. They'd see like somebody around a corner sitting there praying and how they're never going to do that trade ever again. And, if you just let my trade turn back up, I'll never be mad at you again, God, and I will do whatever you say to, like, I mean, it's crazy shit like that. Like it's the trader's prayer. We all heard it. Everybody's done it to some level, maybe not to God or whatever, but you have wished that a trade went back the other direction, and it doesn't. So once again, it's like understanding the risk above all else is incredibly important. And two is like, if you are shorting, and let's say you're shorting an index, like what I do, you really have to understand, one, if I backtest shorting indexes, if I backtest any sort of crashes, trend changes in a system, I learned quickly that shorting equities isn't the way to make a great amount of money most of the time. The systems to short equities just don't tend to make money. And not talking about individual stocks, talking about the indexes as a whole. Um, I think it's more important to, if you're going to be a short seller, find individual stocks, be very good at that, find ways to do it inside of that, and that's the way you can make money. But doing it in a way where you're just finding the ETFs and you're like, hey, I'm going to short the Qs, like, yeah, you'll make some money here and there, but it's tough to do. And the same with the whether you're futures or whatever, it's tough to do in any sort of systematic way, fundamental way. And there's, like you said earlier, there's funds that do these things. The funds that do these things, like those dudes got huge balls, and I give them all the credit in the world. The problem that I have with it is that they just don't make money. Like that's something that we have to talk about. It's like they don't make much money. Once in a while you hear of a great trade or something, and I'm not saying that like you can't do it. I know there's people who've done it. I've met people who do it and do it very well. Just most of the funds as a whole don't make much money because it's hard to do. It's the hardest thing to do in the world is to find an index to short. So find the individual stocks in there. Also, commodities are great shorts. And commodity-based sectors. You could have shorted energy instead of people tried to short the Qs, for the last 15 years. You could have shorted energy at many points. You could have shorted any of those types of sectors, copper sector, any of the commodities, bonds. Nobody ever talks about shorting bonds. Like, why does anybody talk about shorting bonds? Nobody ever talks about that. However, it's like the best trade in history. Like it was the craziest move in history for years. It just kept going down, and like nobody ever wanted to talk about that. So there's many things to short out there. Just to go over it again: individual stocks, commodities, commodity-based sectors because they're very cyclical. And yeah, you can short tech. I'm just saying, find the individual names you want to short. And this way, you're not really betting against the trend all the time.
So the other thing with shorting, right? So when I put out my article on the tweet thread on NVIDIA, and after that, I got a lot of comments where people said, look, your analysis didn't work because the price went up. And I always have this standard answer these days, which is the fundamentals only matter when the price goes down. Or let's say on the flip side, like when I'm long con, even though it's not performing. And my answer to why is the fundamental thesis not working? The answer to that is again, the fundamentals will only matter when the price goes up, because only when you have a particular kind of price action, people take a look. Everyone doesn't have the attention span, everyone doesn't spend all the time looking at the market. So what do? They, when something hits the news, or when something hits, let's say, the newsletters, when something hits Bloomberg or any other indicator, which is mostly when something makes a move sufficient enough to gather attention, that's when people start to look. And that's when people start to get into the trade, and then it kind of feeds on itself. So if you're just looking at pure fundamentals, it doesn't work unless the price starts moving your way, because until then, nobody cares. And then once you have the move that happens, when people start to see it your way and they position the way you're positioned, that's basically the start of a trend. And that's when you see the fundamentals start to matter more and more. And then when you get to the end point, the fundamentals don't matter. All that matters is momentum, all that matters is how other people are positioned. And also, by the time the fundamentals would have changed, let's say I'm long con right now, and con has a wild year and goes up a lot, and everyone is talking about biofuels and blending requirements, and you have talk of E25, E82 gasoline in the US, and you have all this crazy thing. What happens? By then, maybe more refineries come online, and then crude prices drop, and then this whole thing goes for naught. And then the trade turns the other way. But it won't matter as long as the momentum is in the direction of the trend. So you have to, and you have the counter side, you have to wait until the momentum turns again, because the fundamentals won't matter until the price action changes. And so as a trader, you can either wait for the price action and then take a position, or just like what I do, I like to take a small position and just to keep my skin in the game, and then just wait and wait. And so that's the trade-off, right? So you either pay in terms of price or you pay in terms of time, and we make those choices. But fundamentals is just one part of it, and it will only matter during the meat of the trend. It's not going to matter at the extremes.
Mm.
So that's just something that I was thinking about.
No, that's good, and you know, that's why I like that the conversation was brought up, because it's very interesting to think of the fundamentals compared to the price action, because I think it's really important to understand trends. You know, like, not because it's the end all be all, because when you understand where the market's moving and the direction it's moving, and understand that it normally just heads that direction, continues to, you become an incredibly powerful trader. And whatever style you first pick up on, you know, there's plenty of technicians who don't really believe in trends, and they try to buy and sell, you know, resistance zones and support zones and so on. And it's like, until you really understand, like, the most powerful thing in the market is the trends, like long and short. That's the way you make money. You know, you can make a lot of money like that, just on identifying the trends. I mean, really, it's a game of trends. If you really take it all to kind of the simplest form, there's a reason that people have made money without understanding one thing about the fundamentals, barely understanding the ticker symbols, anything, but they could create a trend following system. And maybe they're also you know, very eclectic in the sense where they have no problem being very against the grain. Like, put that all together and you can create kind of these systems and these strategies that will make you a very powerful trader in these markets. Like, if you're understanding that, you know, Nvidia is in this very strong uptrend, like, you know, you don't have to get in front of that. You just can go, okay, well, I will wait. I have this thesis, but I can wait for this turn. And then when I'm waiting for this turn and the turn happens, then you can fire on to a trade. But really understanding that really has to come above all else, because you will get ran over again and again. I actually am a little bit over time here. I gotta get off. Kashap, great having you again, man. This was fun, and let's keep this going.
Definitely, Jason. And it's so awesome looking at your cat in the background.
Yeah, she's just, so they always have some very weird thing of like needing to be in every shot. Like, I had the actually the cat's actually over there now that I see it. Oh no, that's a rubber band. But the couch back there, the one cat would always go and lay on there all the time. And so that was kind of like the biggest, like, what the heck? I don't know how they know I'm filming. And they would just understand I'm filming. And then now this one's just hanging out up there. So I guess they want to be on camera. All
Yeah. All
right, man.
right.
Thanks for coming on. We'll talk soon.
Yeah. See ya.
Later.